Hello, this week's topic's about cash and fixed interest. What are you going to be learning by the time you're finished? Well, hopefully you'll be able to explain all these different things. So what are the basic attributes of bonds? Why are they appealing to people as an investment choice? Describe the essential features of them. Explain how bonds are priced in the market. Explain the different types of bonds and the kind of investment objectives and goals that they would be fulfilling. Explain the behaviour of market interest rates. Describe the term structure of interest rates. Understand how bonds are valued in the marketplace and be able to use the yield and return formulas and understand the basic concepts of duration. Let's get going. So the title of this week is cash and fixed interest. So when we're using these words fixed interest, what we're talking about bonds. So they're called fixed interest because the interest is fixed for a bond. Now what they actually are is a liability. So if you're purchasing a bond, then what you're actually doing is lending money to the people issuing the bond. When you have the bond, then you're going to be receiving fixed interest. So you're going to be receiving a certain amount of interest over a specific period of time. And also you'll receive the principal back at maturity date. So when you're investing in bonds, if you're, for example, you're buying ones from the government, then you're lending money to the government at an agreed interest rate for a set period of time. And they're promising to pay you interest regularly and to pay your loan back at the end of the term. You might not be purchasing these just from the government. You could purchase bonds from companies. So bonds have got some specific terminology that they use. They have a face value, which is the amount that you're going to be paid back at the end of the period. That end of the period is called maturity. When they're paying you those interest amounts, it's called a coupon. And this could be half yearly or quarterly. It depends. So let's have a look at the words. So we've got principal or face value. So that's the amount that you're going to be paid back as the investor at maturity. Coupon, this is the interest income, usually every 6 months. Maturity date, that's the date when the bond finishes, it matures, and the principal amount is going to be repaid. Current yield, this is a formula which measures the annual interest income a bond gives us compared to its current price. A term bond, think of that like, think about fixed terms for our cash. It has a single maturity date, and a serial bond that has multiple maturity dates. How safe are bonds? Well, we've been doing these formulas in the last few weeks where we've been using government bonds as the risk-free rate to use in our formulas. So we've been thinking of them as extremely safe. When we've been discussing that, the proviso is that you're looking at the government treasury bonds. So those are at one end of the scale, extremely safe. You're buying from the government. But bonds can actually range in risk from that end through to the other end of quite risky. So make sure if you're purchasing a bond, you know what you're buying, what are you actually investing in, because not all bonds are the same. Usually bonds are less volatile than other investments such as shares. Think about the share market, it goes up and down. Bonds are very stable. It's still possible to lose money though with a bond if the interest rates change, or perhaps the people who you've lent your money to have gone bust and they're not going to be able to repay you. Bonds have credit ratings, but it can be quite difficult for us as ordinary investors to find this information out, mostly available to wholesale clients. So if we have a look here at this chart, you can see we've got 3 columns: Moody's, Standard & Poor's and Fitch. So they use slightly different ways to record their ratings, but you can see at the top we've got AAA, comes down to B, and then C, and then some of them use D or just do not invest in. So if you have a bond rated AAA, that's right at the very top, and then coming down to, well, from here, BB downwards, we'd consider those to be junk. How safe are bonds? Well, if you're looking at those letters and what rating that they have, then it gives you a good idea. So Moody's and Standard & Poor's, they're 2 of the largest best known rating agencies. So they're looking at analysis of the issue's provisions, studying the firm's earning powers, what's the business's liquidity and the management like, what debt do they have outstanding, and what are their coverage ratios. So as things change with the finances of the business, then the ratings can change. Now it's only measuring the risk from the issuer, not its exposure to the market forces. How safe are bonds? Well, compared to other investments such as shares, they've definitely got a much safer. They're not at all volatile, especially if they've only got a short time frame that they're working in. They're not volatile compared to, say, shares. So bonds are considered to be much safer than shares. And they're often liquid, so people like them because they're going to get that interest, usually twice a year, and they're going to get the cash back when their bond matures. So think about shares. How does this compare to shares? Well, there's no guarantee we're going to get our cash back at the end when we hope to, but you may not get any back, or only half or portion. Shares may or may not pay dividends. Think about last year with COVID, most businesses that did pay dividends reduced the amount that they were paying. So there's not a guarantee at all. Bondholders are also protected legally. If the business goes bankrupt, then as someone who's owed money, then they're likely to get some money back, which is called the recovery amount. But if you're a shareholder, you're not going to get any money back. So bonds also come with an indenture. So this is a formal agreement that establishes the terms, and covenants, which are the clauses. So they specify rights of the bondholder and duties. There are also different types of bonds that would meet different investors' needs. So perhaps you have fixed rated bonds or zero coupon bonds if you don't want to receive income, convertible bonds, all kinds. We've looked at this picture in a few different ways already before. So across the bottom, across the horizontal axis, we've got risk, low risk going to high risk, and we've got our return. So we know that cash is right there at the bottom. Then we have our bonds. So low risk, but also quite low return, but very safe. And then as we move along this graph, we're getting into shares and property. And over here, we've got also small shares, so you can see large shares, bonds, and treasury bills. So you can see here shares quite volatile, minus 60% up to 150% for the return of the share. The larger shares, less volatile, but still quite volatile when you compare that to bonds. We would consider bonds to be very safe, especially the Australian government ones. This is what that is. So why would you invest in bonds? There's an inverse relationship between interest rates and the bond prices. It provides income. So if you're a conservative investor, you want to make sure you're bringing in regular income, then bonds would be great for that. It could provide capital gains or losses if you're a more aggressive investor, and it can be used to preserve capital. They provide some diversification in the portfolio and considered to be low risk. So here we go, we've got our risk, now return again, same kind of picture. So we've got our government bonds right down the bottom. Now bonds from companies, that's more risky and you'd expect a higher return for those, and then we move into our shares.